I'm Will Woodall from CAP STRAT, as joined by always by Mike Rarey. Hey, Mike, how you doing
Hey, Will.
today?
Good.
So what happened? I go out on vacation for a week last week, and the market continues to sell off. You're supposed to correct that for me while I'm out, right?
Whenever you're gone, everybody misbehaves. That's how it works.
See, that's just not good. We have to fix that. Let's throw the first chart up and look at the week. And let's focus not just on the week, Mike, but let's look at the trends year to date, because they're pretty bad, and we want to make sure we can give context to everything.
Yep. Yeah. The year-to-date numbers, given the sell-off we had in September, they've basically gone back down to the lows from mid-June. So we've pretty much been here before. Markets, it looked like they formed a near-term bottom in mid-June, rallied all the way through mid-August, and then once Jerome Powell came out at the Jackson Hole Symposium, that led to the end of the bear market rally, and we're right back to where we were in mid-June. So we've seen these year-to-date numbers before, just to provide that context.
Yeah, and I think, is there anything relevant to sort of this downturn versus the June downturn that we saw, meaning the value growth splits, et cetera?
Yeah, great point. So during the first almost half of the year, the most important thing, it wasn't necessarily the amount of equities you owned, but it was the type of equities you owned was most important. And we saw growth stocks significantly underperforming value stocks, and even saw high dividend yielding value stocks holding up very well during that sort of first leg of this downturn year to date. And as we moved on into this second downturn we've had since mid-August, at this point it's more been the type of equity you own doesn't really matter, because the market is starting to transition from just an inflation scare to a potential recession scare. And so what you're seeing is more value oriented equities, which typically hold up well in just an inflation scare environment, tend to do less well in a recession scare environment because they can be more cyclical, more tied to the energy sector, things like that. So this downturn we've had here since mid to late August, a little different in terms of flavor than the first half of the year.
Yeah, and let's throw up the next chart and look at the value versus growth in terms of where they are relative to their long-term trends and what their trajectory is showing.
Yep. Looking at the Russell 1000 Growth Index in green, growth of $100 since 1988. Put it on a log scale, draw a trend line, and you can see that green line, the index currently, characterize that as high and falling. So it's clearly falling. But you can also see, although it's come down quite a bit year to date, down almost 30%, it's still well above the long-term trend. And if you go back to, for example, the late 90s, early 2000s, you can see that it typically wasn't a good time to start buying until we were low and rising, meaning we would need to see the index come below the long-term trend before we would go into a positive price regime, and we would say, all right, we formed a bottom here and everything looks good, it's time to buy. And contrasting that to value stocks, which if you look at relative to their long-term trend, they've actually already dipped low. So they are below the long-term trend. That's somewhat positive. The only problem remaining is they're still falling. Mm-hmm. So once those get into a low and rising environment, that would be a positive price regime. And that would definitely help in terms of looking at the attractiveness of equities going forward, but we're just not there yet.
And so maybe just comment on the regime changes during the recessionary periods noted here on the graph.
Oh, yeah. So during every recessionary period, so in the early 2000s, it took until about 2002 when the green and the purple lines were both low and it started rising. So that was a positive price factor. In 2008, they flipped from above trend to low, and then same thing during COVID-19. So valuations during past recessions typically become much more attractive, and that results in a positive price regime. We're just not there yet.
Yeah. So let's move on to fixed income. If Audrey, we can throw that chart up. We're getting a lot of questions. The fixed income space continues to sell off. Yields continue to rise. We're seeing a lot of interest rate hikes being priced in, and it's resulted in a lot of losses in fixed income portfolios. So take us through the fixed income landscape and then talk a little bit about the expectations here.
Yeah. So if you look at the year-to-date returns, you can see negative returns across the board. Generally speaking, the worst place to be would have been like a 30-year well below investment grade bond. The lower you are on the credit spectrum, the worse off, generally speaking. And the further you are out on the duration spectrum, so 30 years, those types of longer term bonds, the worse you are, because we've had a rising interest rate environment and credit spreads have started to widen. And those have been the general trends. And you see that reflected in our yield regimes out there to the right. Most of them are high, well, they're all high and rising. And high yields, where we're at now, yields are very elevated relative to their long-term trend. That is a positive. Your starting yield is the overwhelming majority of your future return for fixed income. And so yields now are very attractive, the most attractive they've been since 2008. So from that perspective, bonds are looking very attractive. The last thing we want to see is we need yields to stop going up. We need them to stabilize and even start coming down. Once we get into a high and falling yield regime, that is an extremely attractive time to own fixed income. That's when fixed income really lives out its role as a portfolio diversifier. And we're just not there yet, not until inflation really rolls over, which we think we're on the cusp of that shift, but we'll probably take a couple more months.
Okay. And before we talk about inflation, let's look at the alts chart. Clearly, commodities are selling off, but they're still hanging in there year to date. And real estate is just getting uglier. So maybe comment on those two things.
Yeah, global REITs, they really perform very similar to global equity markets. And so you see that reflected in the year-to-date returns. And then commodities are the only major asset class with positive returns year-to-date. And you can see the strong gains in the energy sector, et cetera. And when the market shifts between inflation scare, that's generally a good environment for commodities. So they've done very well. But then we have these months or time periods where we transition to recession scare. And that's when commodities tend to sell off. And that's exactly what we had in September. You see the month-to-date return there for commodities down over 8%.
Right. And maybe just comment before we move on to inflation, just on the housing market and the sort of the carnage we're seeing there.
Yeah. So the housing market, housing prices had remained relatively stable throughout the spring and even most of the summer, despite the fact that sales activity had dried up and the housing market had come to a halt. But now we're starting to see prices come down on a national average basis, particularly in some of the areas of the housing market that benefited the most during the COVID-19 pandemic. So, and it's not just here in the U.S. We're seeing this globally. Some of the hottest housing markets in the world, places like New Zealand, Canada, et cetera, same type of thing. Interest rates and mortgage rates have been rising dramatically, and housing prices are now just now starting to come down.
That has a bit of a lag effect on inflation, but let's talk about that in context of our inflation forecast, which we're showing that it's peaking, at least at a headline level. Core level maybe still a little room to go, but take us through where we are today and what our forecast looks like.
Yeah, we expect we're moving from high and rising to high and falling. I know this has been a long transition, and if you really get granular here, the headline numbers should start coming down sequentially. The year-over-year numbers should start coming down really through the end of the year, all the way, and then really start to come down more aggressively as we get to spring, early summer next year. The core numbers, however, are going to be a constant point of frustration for the Fed because the year-over-year core numbers are likely to actually move a little higher as we get through the end of this year. So that's going to be a pain point for the Fed, and then those probably won't start to come down more sharply until we get into late spring, mid 2023.
And so that tells the Fed to keep their foot on the gas in terms of rate hikes?
Yeah, gas in terms of rate hikes or brakes in terms of the economy, however you want to do it. But they're going to keep doing what they've been doing. Exactly right.
And at what point do you think where is that? I mean, have they passed the point of no return in terms of they're breaking stuff at a record pace right now,
Mhm.
or do they still have time to recover?
Yeah. Tough to say. Really tough to say. I think we think when you look at it now, you say, what is the risk of them doing too much? What is the risk of them, as you said, going past the point of no return? And if you just listen to some of their words and how it looks like they're monitoring the situation, it does seem like they're looking at lagging variables and they're trying to get core PCE, their preferred inflation gauge, down well below their target for at least 3 months. And, that typically only happens in a recession. So it's quite possible now that they are going to overlearn the lessons of the 70s. And probably in order to win the fight against inflation, they're probably going to have to create a recession.
Mm-hmm. All right. Well, so take that with a grain of salt and look at the liquidity forecast to sort of pair with the Fed's actions here, because it's significant, the liquidity and the correlation to equity prices.
Mhm. Definitely. Yeah, looking at the liquidity forecast, you know, we're still in a low and falling liquidity environment is where we're headed, and sort of the steepest part of that is happening right now. The steepest part of that low and falling, and then you can see after we get this big drawdown in liquidity, should bottom out somewhere around December, but really isn't going to come. It really isn't going to move higher from there. So it's more like a low and low type of liquidity environment, and that is the most difficult liquidity environment for equities, particularly growth stocks. Um, and you see that playing out in markets. This is something that it seems like just now people are focusing on. You watch financial media and financial news coverage, and now you're finally seeing people talk about money aggregates and liquidity, which is interesting because this has really been driving the S&P 500 since the COVID-19 pandemic.
Yeah, yeah. I mean, it's interesting that people are just talking about it now and actually correlating it to equity price outcomes. And we've got another chart here. If you want, Audrey, you want to throw the next chart up that looks at liquidity versus economic surprises.
Yeah, money supply growth is the oxygen of the financial system and also the oxygen of the economy. So, a low and falling liquidity environment is not just a tough environment for stocks, but it's a very tough environment for economic growth. And so you see that play out in this chart. And once again, saying this is not just a US phenomenon. Global liquidity right now. So if you take money supply aggregates of all the G20 countries, translate them back into US dollars, it's negative year over year. There are fewer US dollars worth of money supply in the world today than there was a year ago. And when that starts to happen, when that happens historically, the economic data just starts coming in worse than expected. And so we compare that blue line with the economic surprise index in green and red. And that's where we're at now. And our view is that economic surprise index is going to get more red because this is the greatest slowdown in global liquidity that we've ever seen. Many major central banks around the world are rapidly hiking interest rates. And if they're not, their currencies are rapidly depreciating. So it's very difficult.
Yeah, I just saw, I think it's 85% of central banks are around the world are increasing interest rates right now. So yeah, this is not a US phenomenon.
Mm-hmm.
For sure. Okay, let's translate that into any updates on our recession forecast.
Yeah, recession forecast still above 50, hasn't changed much week over week, but you see our view is that it's probably going to start creeping up back towards the highs of the year, which were in mid-June. So you see 58% of recession over the next 12 months versus, something in the low 20s that we're in a recession right now. And just a couple things to highlight on the next slide. If we look at the individual indicators, some of the movement we've seen here, anything related to the yield curve is flagging recession. The yield curve is extremely inverted. 53% of all yield curve pairs are inverted. Any economic recession indicator based on the yield curve is flashing recession warning signs. And then given that markets are back down to where they were in mid-June, a lot of the market-based indicators are flagging as well. So, if we get a little bit of a relief rally here, now that it seems like we might be retesting those lows from June, hopefully this recession indicator comes down a bit. But our view once again is 12 months out. Recession indicator. Recession is a relatively high probability event.
Yeah. Yeah, I think the one saving grace everyone keeps pointing to is a labor market. That is definitely a lagging indicator. Maybe just make a comment on that relative to recessions.
Yeah, it's at the point now where you look at non-farm payrolls for the last few months, and that gives you confidence you're not currently in a recession, but we're also in arguably the tightest labor market in post-war history, and the Fed needs to solve that problem. And so it's interesting. The tight labor market is the reason why we're not in recession right now, but it's also a main reason why there's an elevated risk of recession 12 months from now. Is the Fed is actively trying to loosen that labor market, and that typically ends up in a recession.
Yeah. All right, Audra, I know there's some questions in the queue. So the first one, why is fixed income doing so poorly? I'll let you tackle that one, Mike.
Yeah. So very high level view. Your returns on fixed income are your starting yield plus any capital appreciation. So if that yield goes up, you lose money. If that yield comes down, you make money. So if you think about where we were to start the year, interest rates were extremely low and interest rate sensitivity was extremely high. So we were just at a very difficult starting point. So let's appreciate that, a very difficult starting point. And then we had an inflation shock. When inflation comes in hotter than expected, fixed income yields go up, and so prices go down. And that inflation shock led to an interest rate shock, meaning the Fed started hiking short-term interest rates aggressively. So that put further upward pressure on yields. And this is all bad news, good news. The bad news is that's a very difficult environment for fixed income, an inflation shock followed by an interest rate shock. And, this is one of the worst fixed income environments we've seen since the 70s. The good news is this is how you get yields high. And high yields mean higher future expected returns. And so that's why we keep talking about this is the most difficult fixed income environment we've seen since the 70s. This is almost also the most attractive time to own fixed income since probably 2008.
Yeah. I mean, back to the earlier slides, it is uncomfortable right now seeing the losses pile up in the fixed income space, but there's opportunities as we move from high and rising to high and falling where you can play the curve to make substantial amounts of appreciation in your fixed income. So the time will come. It's just not quite there yet. Have we put in a bottom now that we have retested the June lows? Nobody knows, I guess.
Would love to say yes. Would love to be able to say yes. But, one of the common characteristics of a market bottom that we've seen is a true Fed pivot. And Fed pivot means a lot of different things to a lot of different people. Do they say, oh, we're not going to hike as much? Do they actually cut? Whatever. For us, within our investment framework, that means we need to forecast that liquidity is going to start moving up again. That would coincide with some type of a market bottom. Why does that happen? Because the Fed actually cuts, because inflation is actually defeated, whatever the case may be. That is one key ingredient for us to really be confident that we put in a bottom is we actually get a shift in the liquidity environment. And there are no signs of that right now.
No. And in terms of volatility, we really haven't seen that real elevated washout volatility, although there's been days where it's risen, but it's not risen anywhere near to the point where you would say we have exhaustion and people will start to pick up the pieces here. We have seen like Apple volatility rise rapidly just in these recent weeks. So those are signs perhaps that maybe we're approaching something, but still too early to tell. All right, next question. Why isn't my portfolio protected with fixed income? I think to your earlier point, Mike, similarly stated, things are going against us in both directions at the moment.
Yeah. For a diversified portfolio, the only other time in history where we've seen fixed income securities sell off this magnitude and stocks sell off this magnitude were in the early 70s. And ultimately, if you want to boil this down, it comes down to, does the Fed have credibility in defeating inflation and restoring price stability? And if the answer to that question is yes, then fixed income should perform much better going forward. Think about how much interest rates and bond yields fell after the Fed restored credibility in the early 80s.
Right.
Those bond yields coming down were huge price gains for fixed income because they finally restored credibility and restored price stability. So that's basically where it's at. And our view is that the Fed does have credibility. If you look at long-term measures in the bond market, they do have inflation fighting credibility, and they've said everything they need to say to lead us to believe that they are going to restore price stability.
Yeah, just a little early right now. All right, what else? Do we have any other questions in the queue? What does a market bottom look like? Oof. Well, they all look a little different. There's themes, I guess, that go across all of them, but every one can be a little different in terms of what happens sort of at the bottom, or there's just there's no like date or price. Like I think that's the most important thing to realize is that no one's going to ever be able to tell you a price or a date. It's going to be a process, and so you just have to sort of work through that process.
And then tack on what it would look like in terms of our investment framework. Given that everybody's been following our framework, what it would probably look like now, we would see inflation, high and falling, transitioning to low. That would be a great sign, which would probably allow liquidity to bottom out and maybe be low and rising. That would be nice, which would allow economic growth to transition from low and falling to low and rising, which would reduce the probability of a recession. And, as that's happening, you would probably see prices of most assets low and falling, or maybe even low and rising. Yeah. So that's sort of the checklist, the historical checklist. And you're not going to get all of those, but you get enough of them that the risk reward seems asymmetric. And you say, okay, well, we might be finding a bottom here.
Yeah. And interestingly, it's almost, maybe not to sound trite about it, but it's almost easier to find a bottom with a recession than it is without a recession, because you get a lot more data to signify where you are and how close you are to a turning point. So we hope if we do get one, that it's short and sweet, but you never know. Any other questions in the queue, Audra? All right. Well, let's wrap it up there for this week. Thanks for joining, and we'll be back next week with another update.